Joining me now is Raj Dhanda, partner and global head of wealth management at Eris Management. Good to see you here, Raj. I think this has been an interesting week in finance. We've seen JP Morgan scoop up First Republic. We're on the eve of potentially another rate hike from the Fed. What's next for markets?
Well, Brian, great question. Good to be here. We really are on the heels of extreme volatility last year in the equity markets, recently in credit. As you mentioned, the credit contraction that's been engineered has led to some bank failures. Ares is really a micro investor that's aware of the macro, so our crystal ball is what it is, just a crystal ball. We're one of the larger platforms and talk to 7,000 or 8,000 advisors every quarter. What we hear are really three things. One is investors want help with a more defensive portfolio today. They certainly want to benefit from the move in interest rates, and then inflation is on their minds. And so we're helping them think about portfolio construction with that in mind.
Why is the broader market, and you're not the first one that has told me investors are starting to get more defensive positioning or more interest in that. Why is the broader market holding up, you think?
So the public markets really don't offer much breadth to the economy. Less than 10% of companies over 100 million in revenues are in the public markets. Ares' lens in the private markets actually gives it great breadth. Middle markets has been core to our franchise. And so what we see is an opportunity to capture both alpha through private credit, through secondaries, through distressed strategies. And you're absolutely right. The public markets are distracting. There's volatility. Individual investors historically have had effectively 100% allocation to the public markets. The age-old 60-40 allocation I think of as 100-0, 100 to the public markets, nothing into the private markets. Now that's changed with maybe 4 or 5% allocated to the private markets, but that's where we spend our time thinking about those opportunities.
Is 60-40 dead? That seems to be another topic here at the conference.
Well, again, I think of it as what is the right portfolio construction that achieves clients' goals. So take, for example, private credit. We manage about $360 billion in assets, about 2/3 is in private credit. Some people would say we're a pioneer in credit. I think the advantages of private credit today are really apparent. One, most of the assets are floating rate, and we've had a material move in the base rate. Secondly, you're defensively positioned. As I mentioned, that's topical for clients. So you're senior in the capital structure. You have a cushion to if asset prices decline. So we see a lot of interest in private credit. We also see the need for diversification. As I mentioned, the public markets don't offer a lot of diversification. Secondary strategies, and another area that Ares has a 30-year track record, is where you can achieve diverse exposure in private equity. You don't have a J curve. You don't have to get the vintage perfect when you're investing in private credit. So those are two areas that we see a lot of interest.
You mentioned you don't have a crystal ball, but what is your macro outlook? If you see people getting more defensive, you see a potential spike in volatility, what does that say about the economic outlook?
So it's a good question. I mean, we reported earnings for ARCC. It's the largest BDC just last week. And we did see 8% EBITDA growth across the platform. So we don't see some material or severe contraction in the economy. If you think about the massive both fiscal and monetary stimulus over the last several years, there has to be now some impact from credit tightening and values coming down, asset prices coming down. But the underlying economy feels pretty good to us.
As someone who manages money and is exposed to this industry, how concerned are you about a default on the country's debt? Lots of focus on the debt ceiling.
Again, the headlines are creating volatility. You'd like to believe that there's some brinksmanship and some politics around it, and that it's a matter we'll get through. Again, the volatility in credit is more recent. In the last year or so, we had volatility in the equity markets. Credit markets, public credit markets aren't meant to have that type of volatility. and that certainly is causing distractions for investors.
Lots of chatter at the conference, too, about the outlook for commercial real estate, which your firm is familiar with. How concerned are you about the outlook for commercial real estate in this country as, again, we might get another rate hike and we still might get a few more? The Fed has given no indication it's getting ready to step off the gas.
Commercial real estate's a large asset class. There are clearly signs of some distress for office assets in large cities. That's a very small part of what we do. Our focus has been in industrial or distribution warehouses and in multifamily and some of the Sunbelt communities around the country. So it's a large asset class, but we certainly are concerned about the headwinds. An area of opportunity in commercial real estate is within debt, and we find that today you can get equity-like returns from commercial real estate debt. And the firm has a credit DNA, a meaningful, large commercial real estate debt practice. And so we're trying to take advantage of those opportunities while being cautious and sanguine about the headwinds elsewhere in real estate.
I think Charlie Munger really scared the heck of a lot of people with his FT op-ed over the weekend on commercial real estate. Is it more of a rolling crisis? Is this something for next year we should all be concerned about? Or, it could happen at any point?
I think it'll be over time. You'll see the impact of this sharp move in the base rate and financing rates. Commercial real estate is an asset class that historically has leverage associated with it, and interest rates have moved materially. So there'll be a period of time where it'll unwind. But again, core strategies for real estate can withstand some of the move in interest rates if you see rent growth that we have seen in certain parts of the real estate market. Is
return to office still a major contributing factor in what you are seeing in the commercial real estate market?
So as I said, office is less than 10% of our exposures, both equity and debt, and it's not something that we see in our portfolio, but certainly, as you and I were discussing, return to office is topical, will remain topical, and something that's on everyone's minds, but not as much as an investment practice.
I'm back in the office, Raj, and I'm wearing a tie, and I'm okay with it.
Well, I think you look good with the tie.
You look good with that one, Raj.
Hard to know how your office is, but our office is back. It's busy, and we're happy to be there.
All right, well, good to see you. Raj Dhanda, partner and global head of wealth management at Ares Management. Enjoy the rest of the conference. Appreciate it.
Thanks for having me, Brian.
Guys, back to you.
All right, great stuff there. You heard from Raj Dhanda, Ares Wealth Management Solutions Global Head of Wealth Management, alongside Yahoo Finance's Executive Editor, Brian Sozzi. Great stuff there.